I'm not a financial advisor, so I'm not going to tell you what to buy, what to invest in, but will tell you what I invested in. Now, when I learned about dollar cost averaging and compound interest, I thought, hey, that's great. That's super powerful. You can't fight math. You can't beat math. Math is just math, and if you have math on your side, you're pretty good. But it doesn't mean that you can just dollar cost average anything and make money. You can't just, you know, invest in whatever you feel like and expect that compound interest will take you the rest of the way, because it won't. You have to be clever, you have to be smart, you have to be sensible about what you buy. So what I did was, I had been told a piece of market wisdom, which was that the stock market always goes up. Uh, no matter what happens in the near term, if you hold it long enough, time is your friend. If you can hold on to whatever you've got long enough, the stock market comes back. And when I first heard this, it didn't seem possible. I'm very suspicious of words like always and never. So when someone says that the stock market always comes back, well, I had to go and look this up for myself. And so what I did was, the S&P 500, the Standard and Poor's 500, is a collection of 500 of the biggest companies on the stock market. And so when people invest in quote unquote the stock market, what they're actually investing in is the S&P 500. It's pretty, how should I say this? It's pretty safe, I guess, in the sense that they are the 500 biggest companies, and as a group, they can be considered to be, representative of the entire stock market or the economy. And this is 500 companies from across the spectrum, from all these different industries, from financials to consumer goods to technology to whatever. All the sectors are represented in the S&P 500. You can say that pretty safely. And so, does the S&P 500 always go up? Does the stock market always go up? Well, here's the market crash in the 80s. This is the dot-com bubble. Here is the 2008 financial crisis. And this is the COVID-19 market crash. So look at each one of these and you will see that, the market wisdom is correct. You hold on to whatever you've got, and if you have time on your side and you can just hold, the market will come back. Doesn't mean that the market will always come back. There could very well be one day where this is no longer true, but we haven't seen that day yet. So what I did was, okay, S&P 500 always goes up. Great. So how do I buy the S&P 500? Because when people say put your money in the stock market, I kind of took that literally, that you'd put your money in the stock market. And to me, the S&P 500 was quote unquote the stock market. It's representative. So how do you buy this? Now, when I first started investing, I don't remember if there were ETFs. I don't think so. I think they were mutual funds. They were basically mutual funds, and those would be managed by a professional, and you paid that professional a fee. And I'm not too down with mutual funds because that fee is exorbitantly high. It doesn't sound like a lot, but when you consider again time and compound interest, well, if compound interest, adding money to what you're investing, compounded is exponential growth, then taking money away at a percentage of what you've got every year, to me, was like compound decay. And mutual fund managers, they get paid regardless of whether or not you make money, right? Whereas compound interest really works best when you're making money. right? It might slow your fall if you're losing money, but uh, fund managers, they were basically a headwind that I didn't want to have because they were consistent, and that scared the crap out of me. So ETFs are like mutual funds. Mutual funds and ETFs are similar in that they gather up a bunch of companies that you can buy all at once through a particular investment, whether that's a mutual fund or an ETF. So you can buy an S&P 500 ETF as if it was a stock. So you buy it on the stock exchange. You buy it as if it was a stock, and when you do, you are actually buying little fractional shares of every company in the S&P 500. And the best known S&P 500 ETF is the SPY. And it's called the SPY because that's the ticker symbol. So if you want to look this up on the New York Stock Exchange, just type in SPY. And as you can see, this is the chart for the SPY over its lifetime, and this is the chart for the S&P 500 over its lifetime. The SPY started around here, 1993. Okay, so disregard everything to the left of 1993, and looking just at everything on the right of 1993, you'll see that SPY is very close. The SPY also costs $400 and something a share. So if you're dollar cost averaging less than $400 at a time, you can't even buy the SPY because it's too expensive. But there's a cheaper version of an S&P 500, the S&P 500 ETF. I don't want to say like these are the only two. There are others, like Vanguard has one, but these are the two that I look at the most. The S&P, the SPXL ETF. Again, you'll see that the graph is very similar in terms of the peaks and valleys. It only costs $97. It was a lot cheaper earlier in the pandemic. You can see that it fell to less than $20, and that was March. So I was like a year ago. So it's gone up almost 5 times since then, which is very unusual. But that happens because SPXL is a ratio. So whatever happens in the S&P 500, the SPXL ETF reflects that 3 times. So if it goes up, then SPXL goes up 3 times. If it drops, then SPXL goes down 3 times. And as you can imagine, this is riskier. SPXL is riskier than SPY because of the magnification of what happens. ZSP is the Canadian version, is a Canadian S&P 500 ETF by BMO. And because it's Canadian, you buy it in Canadian dollars, which means not only do you have to worry about whether the SPY is, or whether the S&P 500 is going up or down, you also have to take into consideration foreign exchange between US dollars and Canadian dollars, because the ETF buys shares of the companies in the S&P 500 in US dollars, but it sells shares of the ETF to you in Canadian dollars. So, if the US dollar goes up against the Canadian dollar, then what you're buying, what you're paying is it changes. Now for me, I didn't want to buy. After a little while, I didn't want to buy all 500 companies in the S&P 500. As I did a little bit more research and I decided what sectors I liked, what industries I liked, and what companies I want to be invested in, I decided, okay, instead of buying all 500 companies, which, obviously I don't know anything. I don't know all 500 companies. I couldn't say that I know at least even a little bit about all 500 companies. I decided, okay, instead of buying all 500 companies, I'm going to take the reins in my own hands, and I'm going to invest in like 2 or 3, maybe 4 companies from the S&P 500 that are really big, that are pretty safe, that they're bound to go up, and I'm going to basically bet that those companies together will outperform the rest of the S&P 500 as a whole. And of course, doing this is riskier than buying the ETF for all 500 companies, because it's a lot less diversified, especially if the companies, the small number of companies, a handful of companies that you're choosing are from the same industry. Then if the whole industry goes down, then all of your investments could go down. Or catastrophe could strike any individual company, and you wouldn't know, right? So that's a general rule of thumb, that being diverse is better risk management. But at the time I was young, and I thought, well, if I can handle risk because I have time, and if I have time, then that means I can hold on to whatever I've got, and the stock market will come back. That was my thought. So I bought Apple, I bought Microsoft. And the nice thing about Apple and Microsoft is that they have a dividend. Does the SPY have a dividend? The SPY does have a dividend, 1.32%, which is actually higher than Apple's and Microsoft's. SPXL does not. ZSP does. Okay. Now the dividend is really nice, because dividend is like free money. It's a share. It's like a profit share that the company gives its shareholders, based on how many shares you own, right? So Apple and Microsoft, in addition to buying their potential to go up, as you can see, they have gone up. You also get the dividend of 1% or whatever. You wouldn't be able to rely on this dividend to grow your investment, because this is below the rate of inflation most years. So it's a nice little bonus, but you wouldn't want to live off that. Disney is my new favorite thing, because I just feel like Disney is everywhere. They have a lot of really valuable IP that they can just exploit repeatedly. They have, of course, the Disney core holdings. They have Marvel and everything that Marvel entails. The most successful movie franchise of all time, Marvel Extended Universe. They have Lucasfilm, which is Star Wars, and Indiana Jones. And they're just kind of everywhere. The Disney Plus has been blowing up, right? So all of these things point to Disney having a really, really strong outlook for the foreseeable future. Now, in my previous video, I talked about 6% interest that you can get for dollar cost averaging purposes, paid quarterly. And when I was doing that, I had AT&T in mind. Look at AT&T's dividend yield, 6.5%. That is huge. It's massive. But then you look at their chart, it doesn't go up like everybody else, right? It kind of just goes, had this spike here a little bit and a little spike here, but for the most part, it's pretty flat. It goes up gradually, very, very gradually, but you would be buying this for the dividend, not so much for the stock price going up. So that was my thing. You could buy these big individual companies. Now, if you want to take on even more risk, you can buy big individual companies that maybe don't pay a dividend but have a lot greater, future potential, like say Amazon or like Tesla, right? And that would be purely betting that Amazon is going to take over the world and that Tesla is going to power everything. And that's something that you can do too. I have shares of Tesla. I have shares of Amazon, in addition to my other safer stuff. And dollar cost average all of that, compound interest all of that, and it could work out really well.